Good afternoon, and thank you for tuning in today, and happy Disability Awareness Month to you. It is also Motorcycle Safety Awareness Month, and those of you who know me and know me well know that I ride a Harley. But I practice safety every month, and one way I do that is I wear a helmet to protect my head. Today, we will learn how to protect your client's income, and this is important since 1 in 8 workers will be disabled for 8 years or more. So during this presentation, I will be pulling back the curtain, so to speak, so that you can see how we customize a plan for your client. There are a lot of moving parts to a disability plan, which can make it very confusing, but it is those very moving parts that allows us to tweak the plan to get it just right for your client. Now today, some of the things that we're going to cover are what I call our quote essentials. Now, the first 3 you should know right off the bat. Everybody knows what age is, everybody knows what sex is, everybody knows what nicotine is, but occupation class I don't think is something that a lot of you have been educated about. And this has to do with your client's jobs duties. State of residence, if we all know our geography, I think we'll be able to figure that one out. Income, I'm going to talk a little bit about what qualifies as income because I think that can be kind of confusing. Benefit period, this is the period of how long your client's going to get the money, and the elimination period is how long your client's going to have to wait before they get the money. And occupation definitions, these are things that can protect your client's specific skill set. And then lastly, we're going to talk about riders. And riders are what we use to enhance the plan. So the first thing we're going to talk about is age. Age does affect the cost of the plan, the same as it does for life insurance and long-term care insurance and annuities and all the other insurance solutions that we offer. The younger you are when you purchase a plan, the lower the premium. This is one of the reasons that we usually suggest retaining a client's current policy rather than replacing it when you come to us and do a policy review. Lots of times it just doesn't make sense to get rid of that policy that was taken out when they were younger because we can never match those premiums. Sex. Now we all know that males pay more for life insurance than females because they usually don't outlive the term. But males do pay less for disability insurance. Females tend to pay more for disability insurance than males due to our plumbing and the ability for us to birth a child. Nicotine. The use of nicotine and marijuana, which is becoming very prevalent, can increase your client's rates by 25%. Now, that's not nearly as much as it does for life insurance, but with most carriers, if your client has not used nicotine in the last year and it doesn't show up on their urine specimen, they're considered a non-smoker. Your client can even smoke up to 12 cigars a year and be considered a non-smoker. Again, as long as it doesn't show up in his urine. Now, if your client is using medical marijuana, this can be a decline with most carriers. Part of the reason that it's a decline is, one, there's obviously a medical condition that the underwriter is concerned about, and then second of all, it's being treated by marijuana, and there may not be any long-term studies done about what the effect of marijuana has on that particular medical condition. So this is Sergio. He's a computer programmer, and this is kind of a little case study so that you could see what the difference is between a smoker and a non-smoker. And this has got a $5,000 benefit with a bunch of riders, COLA, residual, and we're going to talk about those later on in the presentation. But this is surely to show you the impact of a smoker versus a non-smoker. So here we have Sergio. If he was 35 as a non-smoker, he'd be paying about $23, $22 for his premium. If he was a smoker, that same premium would be $29.03. And at 45, he'd be paying $35.20 as a non-smoker. And as a smoker, he'd be paying $4,400. Now, the difference with most carriers between a smoker and a non-smoker, like I said, is about 25%. So encourage your clients to quit smoking and to lock in their premiums at an early age, if at all possible. Occupation class. Now, this is something that I really don't talk too terribly much about, but I think this is a great opportunity for us to educate you on what the occupation class has to do with the disability policy. The important thing to remember is an underwriter only has one snapshot in time to assess your client's duties. In other words, when they look at the application, they have to look at everything. They're looking at their financial, they're looking at the medical, but they're also looking at what is your client's duties on a day-to-day basis. What are they doing from the time that they get into their job until the time that they go home. And some of the things that they want them to do is to actually write down on the application what their duties are, and they need to add to 100%. Some of the things that they're looking for is if there's any physical labor involved in it, or is it a desk job? In addition, if your client is expected to travel, and that travel is going to be 25% or more of the time, that's something that we need to point out to them. It's not that it's a negative, it's just that in the eyes of the insurance company, they're probably going to possibly drop them down an occupation class, and that's because if the primary duties of a client is to get on a plane and to be able to travel to various offices or locations, and by virtue of their illness or their injury, they're not able to do that, there's a greater likelihood that that person's going to go on claim because they can't just transition into a desk job, okay? So let's look at the range of occupation classes. Now, not every carrier has, a B all the way through a 6A, but this is just for illustration purposes. This slide is supposed to represent that the higher the occupation class, the lower the premium. The reason for that is there's a greater likelihood that someone that's making a good income will be inclined to go back to work. So if you're an attorney, if you're a scientist, an engineer, a doctor, there's a greater incentive for you to go back to work because, one, you're probably going to make more money working than you would on a disability benefit. Second of all, if you've paid for all that education to do what you're doing, i.e. a doctor, a scientist, engineer, chances are you want to go back to work. There's an incentive there for you to go back because you enjoy what you do versus staying at home. Now you can see there's a financial advisor listed in 3 locations, a 3A, a 4A, and a 5A. And a little later on, in a couple slides, I'm going to explain that in greater detail so you'll have a better idea. Now, when you get to the 2A down to an A and a B, these are more physically demanding jobs, so there's a greater likelihood that these people, by virtue of their illness or injury, probably would not be able to transition into a job that would allow them to sit at a desk or take on more of a cognitive ability. And keep in mind that Brian and I, we do our very best to try to find the company that has the best occupation class for your client's particular occupation, because we do know that that's going to affect the premium. So let's break down in greater detail some of the occupation classes. Essentially, this is going to combine the 6A and the 5A. So as you can see, we've got an architect, an attorney, and you can see our financial planners here. A financial planner that would qualify in this classification has to be making $150,000 for the last 2 years and has to have been in business for at least 5 years. Now, this category represents occupations that don't present a lot of on-the-job risk either. Someone who is an engineer, a computer engineer, these people, they're usually sitting at a desk, so they're not probably going to be injured on the job, which is something that they take into consideration. Now, if you have a business owner who's making $150,000, has 50 employees, this is going to be assumed, in this occupation class, that this is a desk job. This is not a construction owner who's out there running the crane too. And the scientist is also someone who's not actually working in the lab, but rather doing research in a desk computer environment. Okay? So individuals in this occupation class would probably want to come back to their jobs because it truly is a career for them and they enjoy the work. Now here we have a 5A occupation class, and again, you've got your business owner, something that is not going to be physically demanding, and the veterinarian, this is a small animal clinic, dogs, cats, bunny rabbits. This is not, someone out there working with horses and cows where there's a greater likelihood that they could become injured. And again, someone who's a veterinarian, the idea here is that they're going to want to come back to work, and that's one of the reasons they're getting the 5A occupation class. And here we have the 4A, and again, these are just some samples. I couldn't possibly, include every particular occupation class, but these are just samples of what we see predominantly. And here again, you have a financial planner. The 4A basically says that they would be making $75,000 for the last 2 years, and they too have to have been in business for at least 5 years. The accountant here is not a CPA, but rather an accountant that has a 4-year college degree. The teacher would normally be a 3A, but because they have a master's degree, they qualify for a 4A. The 4A is pretty much like a middle management type occupation classification. And then when we get to the 3A, you're going to see more of that, a variety of physically demanding jobs and some desk jobs, and jobs that have kind of a variety of different duties. So the one that I want to touch on here is consultant. Consultant is in the middle of the occupation class 3A because it's a very generic title. I have a lot of advisors who come to me and say, hey, I have a client, he's a consultant. And normally I have to dig down and find out specifically what exactly that is, because it's such a generic term for a variety of different things that someone could be doing. The reason I dig down is, one, I need to find out if they're a consultant working for a firm or if they're a consultant that is self-employed. You know, we have situations where someone was working for a firm, decided to go out on their own, and now they're a consultant. A consultant working from home, or anybody working from home that is self-employed, is a little bit tricky in that, in the eyes of the insurance company, there is nobody looking over this person's work, what they're capable of doing. For instance, if I worked at home, my boss, Mark Mauer, would want to know particularly, what am I doing? And he would be my eyes and my ears as to what my production is. When you're self-employed and you're working from home and you're supposedly disabled, who knows for sure what exactly you're capable of doing? Not to mention, when you're self-employed and you're a consultant, unless you have a contract that proves what your income is going to be from year to year, that income can fluctuate from one year to the next. So there's some inconsistency there, and that's one of the reasons that underwriters choose to keep them in a 3A classification. And here we have our 2As to our Bs, and these are a lot of what I would consider to be physically demanding or labor-intensive positions, and they may not have the skill set to transition over to a desk job. So therefore, you know, if you're a baggage handler and you can't, you know, physically pick up the luggage anymore, and you can't really transition into a computer job, you know, what else are you going to do? You're probably going to sit out on claim. And there's not a career there. It's not an incentive position where, oh, I want to get back and handle that luggage, as opposed to maybe that veterinarian who's anxious to get back to treating those sweet little animals. So that's one of the reasons that you're going to see, you know, the classifications fluctuate from one job occupation to another. So we haven't talked anything about medical. I don't know if you noticed that in out, but specifically there was no medical involved in there because I wanted to take the opportunity to specifically talk about it across the board. So with medical, we have 5A, 4A, and 3A primarily are what Brian and I look at with regard to, you know, physicians. Now, on the 5A, the reason that these individuals are qualified as a 5A is because they're not doing anything too terribly invasive. Gastroenterologist probably would be considered invasive, but he's using a tool, if you will, as opposed to his hands actually going in there. A cardiologist, dermatologist, neurosurgeon, ophthalmologist, orthopedist, invasive radiologist, urologist, they're doing procedures that could, obviously they're using their hands, and there's a greater likelihood that they could become injured, or by virtue of the fact that they're injured or diagnosed with an illness, would not be able to do these jobs. And then the reason that we have the 3A is simply because these particular individuals don't have a great history. ER physicians, pain management doctors, anesthesiologists, nurse anesthetists, these type of individuals, in addition to having a lower occupation class, they also get dinged because they have the propensity to go out on a mental nervous or a substance abuse claim. And the reason for that is simply because, one, as the ER doctor, they're being exposed to a lot more stress, so they might go out on an anxiety or depression claim. You have the anesthesiologists and pain management doctors who have access to narcotics, so they have a tendency to go out on a substance abuse. So individuals in these particular occupation classes, those four, they automatically, with most carriers, are getting a 24-month benefit period for any substance abuse or mental nervous. You know, the claims experience has just shown that it's not if it's going to happen, it's basically when it's going to happen. So carriers are limiting the benefit period for those particular individuals for mental nervous and substance abuse. The reason dentists are in this 3AM classification is most of the time a dentist is going to go out on a back claim or some sort of musculoskeletal. And the reason for that is simply because they are leaning over all day long. So that's one of the reasons that you'll see them in that occupation class. So this next slide is to illustrate the impact of the occupation class on the premiums. So here we have Raymond. He's a 4A financial planner. So he's making $75,000 or more, and he was able to be eligible for $23.36 of he was eligible for $5,000 of monthly benefit, and in his occupation class he'd be paying $2,336, which not too bad. But look at Rachel here. Rachel is doing the exact same job with the exact same benefit with the exact same age, and she's paying 72% more. The reason I think this is important to explain is there are times where advisors come to me and they submit quote requests for a couple that are making similar incomes, similar occupation classes, or similar occupations, and they are always questioning, why is the premium so high, you know, on the wife? And it's because they have that plumbing for the childbearing years. And insurance companies know that they have a tendency to go out on claim more often. So they're going to charge them a little bit more, well, actually a lot more, in this case 72% more. And statistics demonstrate that women are more likely to become disabled than men. So at age 45, I think it was interesting to see what the difference is. So at age 35, females are paying 72% more. Here we have Rick. He's a financial planner, and he's a 5A OC class because now he's making $150,000 more, but he only needed $5,000 more of benefit. So he's paying $3,061 for his monthly benefit, and his premium is, his monthly benefit is $5,000, his premium is $3,061. But here we have Rhea. Rhea is paying $41.96. So granted, it's not 72% more, but she's still paying 37% more than Rick for something that she can't change. She has no way of changing her gender. So this is just to illustrate why you'll see a difference in premiums between males and females for the exact same benefit amount. So the next one is state. Always need to know the state of residence. I'm not sure if you guys understand this or not, but insurance departments in every single state are what regulate the insurance companies that operate in that state. So if they're going to propose a plan, if they're going to change a plan, if they're going to change riders, if they're going to change premium, rate increases, all that has to be approved by the Department of Insurance. So there are instances where the plan that you see in Georgia is completely different than the one in California. And that's simply because California has not approved the new changes that have been made to that plan that the Department of Insurance in Georgia has. So the biggest ones that we see that deviate from the norm are certainly California, New York, Connecticut, New Jersey, and Texas. So again, some riders and some features may not be available in all states. The next one is income. And income is based upon earned income, including base salary and a bonus, base salary and commissions. So even if your client is an S-Corp, we can include distributions in addition to any kind of W-2 wages that they might be paying themselves. We can actually include stock options if they were exercised and appear on a W-2. All that is considered in earned income. Now, some of the financial documents that an underwriter is going to request to approve someone's application is going to be tax returns, W-2s, year-to-date pay stubs. If your client is relatively new in business, they might want to see a P&L and K-1s. If your client is a 1099 contractor, then we're going to need to see a contract that shows what their expected salary is going to be for at least the next year. This is something that, you know, like I said, when we have that person who decides to leave their firm and wants to be a consultant, we need to see that they have a contract if we're going to try and get them disability within the first 6 months of them, going out being a consultant. Because obviously there's a big risk there on the part of the insurance company to know whether this consultant is going to make it on their own or not. Now, the benefit amount kind of ties into the income in a certain degree. So the thing I want to point out with the benefit amount, which is the amount that your client is going to receive in the event they become disabled. This is what's going to help pay their bills. This is what's going to put food on the table. This is what's going to help, ease their mind and provide a safety net in the event they become disabled. So when Brian and I run a quote for disability, it's just that. It's a quote. It's not a given that they're going to be approved for that amount. It's just a point of reference, if you will. So once the underwriter sees all the financials, the final benefit might be higher or the final benefit might be lower. If it's higher, we'll always ask you and the client if they're interested in getting a higher benefit amount, and we will run a quote so they can see what the premium is going to be on it. And certainly if it's a lower benefit amount, we're going to notify the advisor and the client so that they realize that the policy is going to be issued for a smaller amount and if they still want to accept it. In addition, if the client is eligible for unearned income, so let's say the client is receiving unearned income in the form of royalties, rental property, investment income, trust income, anything that continues to flow to them, whether they have the ability to work or not, that can be looked at as a negative in the eyes of the insurance company because they don't want someone double dipping. There's no incentive for someone to go back to work if they're getting 100% of their income, which is why insurance companies don't pay that. They'll only pay like 60 to 70%. But if you have a stream of income coming in from another source, there's a greater likelihood that that person has no incentive to go back to work. So what they'll normally do is they'll lower the benefit amount that the client is eligible for if they see that they have this unearned income coming into them. And just so you know, Brian and I routinely will run the benefit amount at the maximum amount that the client is eligible for based upon their income. If you don't want to see that, then in the quote request, please just indicate the dollar amount that you want to see. And I think the quote request allows that. You could put in any dollar amount, and that's what Brian and I will run. Benefit period. This is the period of time that your client can receive the benefit in the event they become disabled. And it runs the gamut. It runs the gamut for several different reasons. You have, obviously in this slide, we have 2 years all the way through to age 70. The reason that they range is for a couple different reasons. One, those lower occupation classes, the Bs and the As and the 2As, they may not be able to get an age 65 or higher with a lot of companies. They don't want to see a baggage handler on claim to age 65. It's just not going to happen. They're going to limit their liability there. Another reason that they have a lower benefit period available is for people who have health conditions and they don't want to go and pay a claim to age 65 for them. And I'm going to give you an example of the one that we see most often so that you can put your little radar up when you see this and kind of put 2 and 2 together. Okay? Some of you may know this already, but I think it bears repeating. 5 years. 5 years is the one that if you see that, chances are your client is taking some sort of anxiety or depression medication. The reason for this is 15 to 20 years ago, if you had a client that was taking that type of medication, an insurance company would just straight up decline them. Well, since so many people are on this kind of medication, insurance companies had to kind of relax that position, and what they decided to do was to make some modifications to the offers to those individuals. The biggest thing is they put a mental nervous exclusion on it, so if your client goes out on a claim, or excuse me, if your client is disabled because of that, there will be no claim paid. Second of all, there's no future increase option riders. There's no way to increase that monthly benefit. It is locked in, it remains stagnant, and it's because they don't want to increase their liability. The reason for all this is because, and the reason they limit the 5-year benefit period, and I get asked this all the time, if they're not going to pay a claim for mental nervous, why are they doing this? Why are they penalizing me again? And claims have shown that individuals that suffer from anxiety or depression have a tendency to go out on claim for 4 other diagnoses that the insurance company would have to pay that claim to age 65 because it doesn't come under the heading of mental nervous. And those 4 are GERD or acid reflux, rapid heart rate, insomnia, and what did I say? And headaches, migraine headaches. So what happens is they'll just limit it to a 5-year benefit period instead. So that's the reason. If you ever see that, that's why you're going to kind of put 2 and 2 together, like I said, and go, okay, something must be going on there. Now, there are some instances where a 5 or a 2-year will go on there because of a medical condition that's really not mental nervous related, something like Crohn's, or they might have a new case of sleep apnea or some other medical condition that the insurance company is a little bit concerned about and is not willing to go the distance to, age 65. Now, elimination period, 90 is flashing here because we default to 90 for every single quote unless you tell us otherwise. And that's because the vast majority of advisors that we work for, they insist on having a 90-day emergency cash fund available for their client. So if you want to see something different, you can save some money by going out to 180 or 365 days, and I'll show you that in just a minute. So here's a 45-year-old male, and what I did is I showed you a 3A, a 4A, and a 5A occupation class, and what it would be for a 90-day versus 180 versus a 365-day. And the savings represents if you went from a 90-day to 180-day. Now, it's not a huge amount. It's not like, okay, make your client quit smoking and save 25%. But if you need a little bit of wiggle room in that premium, this is something to consider. And then here we have, as a female, it's not nearly as great. It's like 7 to 8%. But again, it's just an opportunity for you to tweak the plan in order to make it a little bit more palatable. So the riders. The riders is a huge opportunity for tweaking because not all riders fit the clients, depending upon what their situation is, how old they are. But again, we put them on there, and this is an opportunity for you to get back with us, maybe get back with the client, discuss it, and then we'll do whatever you ask us to do with regard to those. So let's talk about the first rider. This is called the Future Increase Option Rider. This is the rider that we put on the plan that allows your client to increase their monthly benefit as their income is going up. This is really important when you've got someone in their late 20s, 30s, and 40s where they're starting to peak, particularly like with doctors, and they're going to be making a lot more money. You don't want a stagnant $5,000 benefit, and then 10 years later, when they go out on claim and they actually need $15,000. So what this rider does, it allows them to increase the monthly benefit with no more medical underwriting. It's simply financial. And this is something that is so important to us at LLIS that we have somebody here, Taylor. If any of you talked to Taylor when she was our office manager and receptionist, this is Taylor's position now to make sure that our clients don't allow this to slip between the cracks. The next one is the COLA rider. This is the cost of living adjustment rider. The thing to remember with this one is it kicks in when your client is on claim. This has nothing to do with when they're paying their premium. This is when the client is on claim. There has to be a mechanism to increase that monthly benefit so that they can continue to pay their bills as their bills go up. Normally, it's about a 3%, and it's compounding annually. So this is one, again, depending upon how old they are. COLA may not be important if you've got a client who's 55 years old. This next one can be called residual, or sometimes you'll see it called partial. Basically, what this rider does is it says that if your client has the ability to work part-time because they're residually or partially disabled, but they can ease back into the workforce after maybe being out on a total disability claim, or by virtue of the fact that, let's say, they're diagnosed with multiple sclerosis and they're never going to be able to work full-time again because of their condition, perhaps maybe the medication that they're taking, but they can work part-time. This allows them to be able to dip into their disability policy as long as they're losing 15% or more of their pre-disability earnings. I think this is one of the most important riders because nobody has a crystal ball and nobody knows for sure if the doctor is going to deem your client totally disabled or not. This next one, meow, this is the catastrophic rider. This one is probably the rider that gets taken off the most often if we need to tweak the plan, because this one is layered over the base benefit. So if you have a base benefit of $5,000, you could in theory have another $3,000 with the CAT rider or more. It's paid in addition to, so in that case the client would get $8,000. Now I always call these categories for triggering. So the first category would be if your client has a cognitive brain impairment or they suffer from dementia, Alzheimer's, any of those, they're automatically qualified for that. The second one is if they lose 2 or more of their activities of daily living, which hopefully a lot of you are familiar with those, the bathing, the dressing, the toileting, transferring from bed to chair, continence, eating. If they lose 2 or more of those, they're eligible. And the last one is more of a physical. If they lose the use of, or they actually lose an arm and a leg, or both arms and both legs, the ability to speak, vision out of both eyes, or hearing out of both ears. Any one of those would be a trigger. The thought process behind this additional benefit is simply because if your client is catastrophically disabled, they're obviously not going to be able to work, and chances are they're going to need to have someone come into their home to help take care of them, so that's an additional cost. Plus, they might need to make modifications to their home. So this allows some additional funds to be allocated to your client during that time frame. And then the last rider, and sometimes this is a rider and sometimes it's built into the actual plan. It's just going to depend, and we're going to delve into these right now. So the first one is the own occupation rider. For those of you who are familiar with this one, this is the one that is most sought after. It's the most comprehensive. What this one says is if your client can't do the substantial material duties of their occupation, and they choose to, they don't have to, but they choose to work in another occupation, they're going to get 100% of the income from that new occupation plus 100% of their monthly disability benefit, okay? Doctors, surgeons, CPAs, accountants, people who have spent a lot of money for their particular skill set, and it's by virtue of the fact that they can do that job is what generates their income. This is really important to them. Now, the transitional one simply says is if your client can't do the substantial material duties of their occupation and they transition into another one, let's say they transition into being a teacher and they're not making the same amount of money, they get to collect 100% of the income from that new occupation, but they don't automatically get 100% of the disability benefit. They can dip into it for the shortfall of what they're not earning in their teacher job as opposed to what they were maybe as a doctor. And then the your occupation, which is what's built into most disability plans, even, like your group plans, this one just says that if you can do any job based upon your education, your skill set, your work experience, you're going to be asked to do it. Okay, so we covered a lot on the individual disability, and just keep in mind the individual disability is designed to pay your client's personal expenses, their mortgage, their utilities, their loans on their car, their credit cards, all that kind of stuff, college, whatever it is that they have to pay on a personal basis. That's completely separate from business. With business disability, the income is not always the key factor since it's not individual disability, but rather it could be buying out a business or paying the overhead expenses of a practice. Those are the things that are important for a business. So I don't know how many of you out there own your own practice, or perhaps you have clients that are business owners, but I think it's really important that we discuss the coverages that are available to business owners, because a business disability policy has a lot of the components of a non-disability plan, but there's some various types, and we're going to go into greater detail in all of these. So just real briefly, age does factor into it, just like individual disability. Sex factors into it, just like individual disability. Nicotine factors into it, just like individual disability. So I'm going to cut right to the chase. What is the plan? So if an advisor comes to me, calls me up and says, Kathy, I got a client, he owns his own business, it's da-da-da-da-da-da-da-da-da-da-da. I usually will come back and say, well, does he have any other plans in place? And the reason I'm asking, does he have any other plans in place, is because you as advisors, you know how to protect your client's personal income, but I don't know that you work in the insurance arena enough to know how to protect a business owner. And, there are various options available to business owners. So one of the purposes of this particular presentation is to help you when you have a business owner client. So let's go into some of the plans. There's primarily 4. The first one is a business overhead plan. And then the next one is the business loan protection plan, which is actually part of the BOE plan. And we're going to talk about that in just a minute. And then you have key person. And then lastly, you have the buyout. So let's talk about the occupation classes. So the occupation classes are a little strange here. Obviously they start at 6A, and with some they go all the way down to A, and some they go to 3A. And I think that's simply because they can't zero out people who might be, in the construction business, but they own their own business, and they need to have these plans available to them. So that's why I think it runs the gamut, so not to isolate anybody in particular. The only thing I want to say here is the key person plan. It can't be found in all states. There's 1, 2, 3, 4, 5, 6 states that key person cannot be found. Other than that, all these other plans are available in every state. So the most common business plan that is requested to me is business overhead. Business overhead is designed for business owners. If it's a fee for service like a CPA firm, like what you guys do, it's great for up to 8 owners. If it's another business, 1 to 4 is probably the target market for that. What it does is it provides a benefit owner. So if you have an individual who owns a business and for whatever reason they can't come into work, they don't want to take away the money from their individual disability to pay the rent on the office space, to pay their employees' salaries, to pay the professional dues, to pay the utilities. There has to be a plan that is designated simply for that. And that's what business overhead does. It's to keep the doors open and to keep the practice running or the business running while the owner recuperates from their disability. And it also provides a business for the owner to come back to, okay? And hopefully, there's someone there that can keep the business running while they're absent. This is on our website. It's called the Disability Expense Worksheet. It's under Advisor Tools. So if someone comes to me and is interested in business overhead, this is something that you would have the client fill out so that we can find out what their monthly expenses are for these particular items, because these are the ones that we can actually use for the plan. So keep in mind that it's designed to pay, business expenses, not personal expenses. So with business overhead, the maximum monthly benefit is $30,000. So if a client has $50,000 in expenses, we're not going to be able to get them $50,000. And these are eligible expenses. Someone could be spending $50,000, but not all of them are eligible for reimbursement. And it is reimbursement based. The reason I bring that up is because let's say someone has a $30,000 plan, but they only spent $15,000 in expenses that month because it was, a funky kind of month. Well, they're only going to be able to get reimbursed $15,000. Just because the benefit is $30 doesn't mean you automatically get it. But that other $15,000 stays in the pool, so they would have that available for the next month. Now, something that's available to business owners is what I call the multi-life discount. So we can reduce the premium by 20% on their individual disability, and if they purchase a business disability, the way it works is we have to have 3 people under the disability plan, or under the employer plan. So if you have a dentist and he has a dental hygienist and office manager, and he wants to purchase a disability plan, he can purchase one for himself. It's got all the bells and whistles, and he can get 2 real cheap plans for the office manager and the dental hygienist, and all of them are going to save 20%. And if one of them leaves the dental office, they still get to keep the 20%. Another way that you can do it is, let's say the dentist wants to buy a plan, he's paying his premium, and then 6 months down the line, he says, you know what, I want to reward my dental hygienist and my office manager. If he rewards them within a year with a plan, they will retroactively go back and refund his premiums by the 20% discount, so that, as long as it's all done within a year, he can get the refund back on the discount. So that's something that we can always take into consideration too. Now, the benefit period doesn't go all the way to age 65. It has a limited benefit period because basically if the owner isn't back in 24 to 30 months, chances are he's not going to make it back at all. So that's why you're not going to see a very long benefit period. The elimination period, not going to be a real long elimination period. The reason for that is simply because you want these bills to get paid. You don't want people's salary. You don't want the rent. You don't want the utilities going, a very long time without getting paid. So chances are we usually run a 30-day elimination period on this. If someone has a pool of money they could tap into to pay the bills for a little bit longer, we would certainly, want to consider that too. There are no specific occupation definitions associated with business overhead, but there are some riders that you could add on to it. The future increase option rider, this one's really important because if your client's expenses do go up, if they were running at $15,000 and now they're $20,000, we want to be able to increase that monthly benefit, as those expenses go up, and that's what that future increase option rider would do. And residual, if the owner is able to work on a part-time basis and is able to generate some revenue, but still has a shortfall in being able to pay his bills, this will accommodate that as well. Now, one of the nice features of the business overhead is it has a rider, and it's called the Business Loan Protection Rider. And you don't necessarily have to have a monthly benefit for the business overhead, like $15,000, $20,000, $30,000. You could just purchase the business overhead, zero it out, so that you can get the Business Loan Protection Rider. And this is designed for business owners that are fee-for-service, 1 to 8, other businesses 1 to 4, very similar to the BOE. What this does is it provides a monthly benefit for that loan that perhaps the owner took out. So they might have taken out a balloon loan. These are all the different kinds. And what's nice about it is they're not trying to take that $15,000 or $20,000 monthly benefit, the business overhead, and try to allocate, $5,000 or $6,000 of that to pay the business loan. This will actually do it for them. And this can be a reimbursement, or it can be paid directly to the lending institution. So the money will go directly to them. And here's the details to it. It could be as much as $20,000 a month or a $2 million loan, including principal and interest. And it can be taken out while the loan is in process. So the nice thing about that is if the loan institution, lending institution, sees that you have the ability to purchase this plan and you're going to, there's a greater likelihood that they would give you the loan knowing that they're going to get paid whether you're disabled or not. We would just need to see if the loan hasn't closed, something that says, what the commitment is. This will even go for individuals. So if you're buying a practice, like, you're a financial planner and you're buying someone else's, if you can show proof of a promissory note, we could also use this plan in that instance too. So the way it works is it's there until the end of the obligation. You do have to keep it in place for at least 3 years or up to a 30-year maximum. If you pay it off early, not a problem. We just cancel it, but it cannot go beyond age 65 or the loan term, okay? And this one has the 30, 60, 90-day elimination period, just like the BOE, but it also has 2 extra elimination periods, the 180 and the 365 as well. So here's a sample for you so that you can see a case study. This is Eric. He's an optometrist, and he wanted to make sure that he was able to pay the rent and his 2 staff members in the event that something was to happen to him. And he has a colleague that would come in and run his practice a couple times a week, at least in the beginning, just to see how it went. No one has a crystal ball to know what was going to, put Eric out on a disability, but he was just trying to think things through and see what he could do. And he'd also take it out a loan for a digital refractor and also a phoropter, those machines that they stick in front of your eyes. And he also purchased some computers. So he had a loan out there that he was concerned about too. So what we did is we had a business overhead amount of $15,000 to help pay his monthly bills, his rent, and his 2 staff members. And then $8,000 to pay off his loan, which is, payable for 10 years. And he wanted the money right away, so we did a 30-day elimination period. So the premium for the business overhead expenses is $2,400, and for the business loan premium, business loan protection plan, the premium is $2,527 for just under $5,000. He knows that he could keep the doors open for a little bit, and make sure that if something was to happen to him, he could keep his practice going and possibly have a practice to go back to. Now this next one is key person. And we're going to switch gears and talk about what I consider to be myself. I'm a key person. Mark may not agree with it, but I think I'm a key person to LLIS. What this does is it provides a benefit to the owner of the company. In this case, it would be LLIS. So LLIS would own the policy, they pay the premium, but I'm the insured. So all the information on the application would be me filling it out, but I don't get anything in the event that I become disabled. If I already become disabled, the benefits are going to go to Mark's company, LLIS, and he can choose to do whatever he wants with the money. But where this is used is if you have a key person, whether it be a salesperson, maybe a chief technology officer, someone who you feel is vital to the organization, and if something were to happen to them, they would that would have an adverse effect on the company. So here's some details on it. The minimum premium is $200. The income on that key employee has to be at least $30,000, and the benefit can be paid either in a lump sum or a combination of a lump sum and a monthly benefit. Now, if there's a monthly benefit being paid, it has to be paid prior to the lump sum elimination period because there's two different elimination periods. The key person has to be under age 55, so I definitely don't qualify for this. But again, what this is supposed to do is replace that lost revenue while you're trying to find maybe that you have a superstar salesperson and they have become disabled. You need to make sure that there's someone within the organization, maybe the other sales staff can pick up the slack and they might be able to, cover for a while. So when you look at these benefit periods, that's what you have to consider is how long can we go in this situation? So if you've got 3 or 4 other salespeople that can pick up the slack, maybe you don't need that long of a benefit period. But if you have like the chief technology officer and you're going to have to hire a recruiter, an executive search firm to find them, you might need that money for a long time. So you might need that 24, that 30-month benefit period. It just depends upon what type of situation the key person is working in. So again, it's to recover that lost revenue. So here's an example. We've got Michael. He's the Chief Information Officer, Chief Technology Officer, whatever you want to call it. He's 45 and he earns $100,000, but he's vital to the organization. So his company purchased a $15,000 a month benefit plan that'll start paying after 90 days of him being disabled. And then if he's not back in a year, it's going to give them $165,000. So again, you're going to get a little bit every month as they're trying to maybe pay the recruiter's fees to try and find someone, and then a lump sum at the end of the 1 year. And the premium on this is not that much. It's just $1,700. But again, it covers that particular situation in case someone does have a key person. The last one we're going to talk about is buyout. And, buyout is probably one of the most important ones, but only 18% of succession plans are funded with any kind of disability buyout. So there's a huge gap here. It's usually designed for 1 to 4 business owners. Good examples for people like this are principals of a business. So like if you have, financial planning business, and you've got 3 or 4 partners, that would be a great one. It can't be a retirement plan where you've got, a 35 or a 40-year-old and he's buying a plan or he's buying a practice or a business from, a 55, 58, 60-year-old where, that other person's going to be leaving. They have to be relatively close in age and they can't be close family members. So it can't be spouses or a parent-child buying each other out. It could be in-laws buying each other out. It can be cousins buying each other out. And a buy-sell agreement doesn't have to be, in place at the time the application is made. $5 million in revenue is kind of like the middle of the road type of business. So the key thing to a buyout is everyone has to purchase it. So if you've got 4 business owners, all 4 have to buy it. Otherwise, it just doesn't work. And some key elements to the buyout is there has to be at least a 10% ownership by all the owners. This too can pay out in a lump sum or it can pay out monthly or a combination. And this one pays out for 24, 36, and this one actually goes to 5 years. The maximum benefit that it will pay is $3 million. And this one, too, is eligible for that multi-life discount. So that's a great thing to keep in mind, too. And then this one has a benefit period. Again, it only goes to 30 months. This one's a little bit longer, you know, because of than the BOE. And the reason for that is, again, you don't know how long that person's going to be out, and you don't want to you don't want to force that buyer to sell his shares too soon. You know, after 24 months, 30 months, obviously you're going to know if that owner is going to be able to make it back and whether he's going to be interested in selling his shares. And then the elimination period, again, we're going to go a little bit longer because you don't want to rush this. You want to make sure that this owner has an opportunity to decide what exactly he wants to do, okay? And here's an example to kind of help illustrate it. This is a CPA firm. We've got John. He's 45. He earns about $200,000, and the business value is $2 million, and it's between him and another partner. So there's a 50-50 ownership there. So his monthly benefit to buy out would be $16,670, and his premium, his elimination period is $365, and we went all the way to 5 years for him, or on this plan. And his premium's just under $4,000. Now his partner, Jack, is a little bit older. He's 50, same exact plan. He makes $200,000, 50-50 ownership, but his premium is going to be slightly more, just under $5,000, and that's roughly because he's older than John. But these are just some illustrations as to how these plans work. Now, I know I covered a lot today, but the thing I want you to know is that hopefully you've learned a little bit about the inner workings of a disability quote, and hopefully we'll be able to explain the moving parts a little bit better to your client. That's not to say that I wouldn't love the opportunity to speak to you and explain it better to you and to your client, but this way you're armed with a little bit more knowledge than probably you would have had you not listened to the webinar. I especially want to make sure that your business owner clients are adequately protected, because as their advisor, you don't want to leave the source of their income and their lifestyle unprotected. So hopefully some of you will be able to join us for some of these events that are coming up in May. NAPA Spring Conference, I think Jill and Jerry are going to be going to that. We've got some other things coming up. The top 10 things that make LLIS different. Well, next month we're going to be having a June webinar, 20 minutes to the right annuity for your clients. Be sure you turn in for our monthly webinar. We've got 8 more to go this year. If you see something that would be beneficial to you or to your practice, make sure you register for it. Jerry will be your guest speaker for next month. The top 10 things that make LLIS different. Well, the one that I'm going to focus on are being able to pre-underwrite. Particularly for me, for disability, we can pre-underwrite for your particular situation. If your client has an unusual occupation, income, you know, medical condition, whatever the case may be, we can pre-underwrite and find out how they would be quoted before we actually send it to you or the client. We proudly sponsor all these different organizations, and we have specialists in life disability, i.e. me, that make us kind of different. And if you haven't used LLIS, I would recommend that you try it. It's open 24/7. It's a portal where you can see what's going on with your particular clients. And at this time, I will take any kind of questions you have available.